Imagine retiring sooner than you expected, accessing your retirement savings penalty-free, qualifying for health insurance subsidies, and paying zero taxes your first year of retirement. That sounds unbelievable, right? But I'm here today to prove to you that all of this is entirely possible. This isn't just theory. It's exactly what I'm doing today, this week, and this year with several clients of mine. And these clients previously felt they had to delay retirement because they didn't think they had enough saved. However, after analyzing their finances, clarifying their priorities and their specific financial life plan, we not only confirmed they could retire early, but we also established a plan for them to pay no taxes in the first 5 years of retirement. That's why I'm sharing this video with you today. I want to reveal exactly what's possible without any secrets or complex strategies. Everything I'm about to explain is available to you. You just need to know what to look for. Before we dive in, if you're new here, I'm Eric. I'm a certified financial planner and the founder of WealthBuilders LLC, a wealth management firm dedicated to helping people like you plan smarter and achieve a better retirement. Now let's get started. This video is designed to show you straightforward and accessible strategies for minimizing your tax burden in retirement. These methods, again, they're available to anyone who understands the relevant regulations. The truth is, the most costly error is rarely the first one you make. It's the mistake you never even realize you committed until the consequences are irreversible. Failing to grasp the new tax rules and their effect on your retirement is monumental. It's a crucial mistake that cannot be emphasized enough. So why don't we walk through some of these mistakes? Mistake number one is ignoring the important tax numbers. You need to understand the basics. You need to understand your federal income tax bracket and how the brackets work, the standard deduction, long-term capital gains taxes, etc. These are not just numbers on a chart. They determine whether you're giving Uncle Sam an extra $5,000 or you're keeping it in your pocket. For example, in 2026, the tax brackets are set to change. If you don't plan ahead, you can move from a 12% bracket into a 24% bracket just by withdrawing a little too much from your IRA. So let's say you're trying to live on $80,000 per year. You withdraw too much from your 401k, and suddenly your capital gains are taxed. Social Security is partially taxable, and now your Medicare premiums jump, all because you didn't know what the thresholds were. And if you think that's bad, wait and see how ignoring the Affordable Care Act income limits can really impact your cash flow in retirement. And one of the things I'm going to make available for all of you, if you click below, is these important numbers. So it's really important that you understand, for example, what your tax rates are, whether you're married filing jointly or whether you're single. You know, you can be at a 10% rate, a 12, 22, 24, etc. You need to understand what these thresholds are. You also need to understand what your capital gains rates are. Again, if you're married filing jointly, you can pay 0% on capital gains rates up to $98,900. If you're single, $49,450, etc. Very, very important, as you'll see in the coming minutes of this video. Then the standard deduction, right? So basically, if you're married filing jointly, that's $32,200, or if you're single, $16,100. That's essentially you're paying zero taxes on anything up to that threshold. So really, really important that you have these numbers handy when you're doing your planning. Let's talk about mistake number two, and that's ignoring the ACA income limits. This one gets expensive fast. So healthcare becomes one of the biggest line items in retirement, especially if you retire before 65 and don't qualify for Medicare. That means you're buying insurance through the Affordable Care Act and the various hubs in your state. So here's a real case study. This is hypothetical just for this video, but I really want you to understand the concept. Married couple, both 58, recently retired, and were buying health insurance through the ACA. They thought they were being conservative, but they didn't realize ACA subsidies are based on MAGI, modified adjusted gross income. So they accidentally crossed the threshold of 400% of the federal poverty line, that's about $80,000 to $85,000. They didn't coordinate their withdrawals from 401k, Roth, or taxable accounts. They didn't take advantage of any tax gain harvesting, which we'll talk about more in a few minutes. They didn't leverage the rule of 55. And what happened? Their monthly premium jumped from about $300 a month to $1,000 a month. That's an extra $8,000 to $12,000 per year every year until you reach Medicare eligibility, plus a subsidy paycheck at tax time. So the bottom line is, before age 65, healthcare is a huge tax problem. If you don't actively manage your Maggie, the ACA becomes a silent penalty. So what's a couple things you can do? Well, you can use Roth withdrawals, because anything, if you qualify with the Roth guidelines, all the Roth withdrawals are tax-free. You can use tax gain harvesting, and you can control your taxable income. That's going to help you keep your modified adjusted gross income below that 400% of the federal poverty line whenever as possible. So even if you understand how tax rules impact your healthcare premiums, messing this next step up can really cripple your ability to retire early. Now, the next mistake is rolling your entire 401k to an IRA before age 59 and a half. Another client, recently laid off, around 56 years old, did what most people do. They rolled their entire 401k into an IRA. Big mistake if you want to retire early. They didn't realize they had just killed the rule of 55. Here's the rule of 55 in plain English. If you leave your job at age 55 or older, you can take penalty-free withdrawals from your employer 401k. And there's no 10% penalty. It's still taxed as regular income, but there's no early withdrawal fee. But if you roll that money into a rollover IRA, the rule of 55 is gone. So withdrawals before age 59 and a half, they will now come with a 10% penalty. So in this case, let's say the client needed $80,000 a year to live on between 56 and 59 and a half. All their money was in an IRA. They took an $80,000 withdrawal, but then they're going to pay $8,000 in penalties plus additional federal and state taxes. And because that withdrawal pushed up their income, now they have a higher Maggie, and now their Affordable Care Act subsidies completely vanished. So that one rollover triggered early withdrawal penalty, higher taxes, and higher healthcare premiums. A triple whammy. So what could someone like that do? Well, you could leave a portion of the 401k untouched to preserve the rule of 55 access. So you can use that money for bridging income before you reach age 59 and a half, so that you can control your modified adjusted gross income for the ACA planning. So you can always roll over the rest later strategically. Rolling your 401k to an IRA too early, it doesn't just create penalties, it removes flexibility. The rule of 55 can be one of the most powerful tax planning tools in early retirement, but only if you don't accidentally roll it away. All right, the next mistake, not understanding or leveraging tax gain harvesting. Tax gain harvesting is an often overlooked but incredibly powerful tactic, especially in those low income retirement years. Take this example. A client retired at 60 and was living off cash savings, keeping their taxable income very low. We realized they were eligible to sell appreciated stocks in their brokerage account, and they could actually pay zero in capital gains taxes. Instead of deferring the gains indefinitely, we sold a portion of the stock, realized a $20,000 gain, and rebought the shares, resetting their cost basis. So because of this, there's no tax due, and any future gains are now taxed at a higher cost basis, reducing their long-term burden. So this one move can save them tens of thousands of dollars later on. If you're not planning to harvest gains when your bracket allows for it, you're leaving a lot of money on the table and potentially setting yourself up for a larger tax bill down the road. Now, the last mistake, winging it without a comprehensive wealth plan. Too many retirees go into this phase of life without a coordinated strategy. They wing it, deciding when to claim Social Security, withdrawing from accounts without purpose, and hoping it all works out. That's not a plan, that's a gamble. And so at my firm, WealthBuilders, we follow the RETIRE acronym framework, where R, we tackle risk management, E for expense management, aka cash flow planning, T for tax optimization, I for investment strategy, R for retirement planning, which includes Social Security timing, medical insurance, withdrawal strategies, etc. And E's for estate planning. Every decision, when to retire, how much to withdraw, which account to tap, how to minimize taxes, how to leave a legacy, should be aligned. Without this holistic approach, it's easy to make suboptimal decisions in isolation that could cost you more than you realize. If your current plan is missing these components, or worse, doesn't exist, this is your wake-up call. These 5 mistakes alone could cost you hundreds of thousands of dollars, and depending on your net worth, maybe even millions. The worst part, most people don't even know where they're making them until it's too late. But all of them can be avoided if you know one simple truth about retirement tax planning. If this kind of detailed, proactive retirement planning resonates with you, I encourage you to book a complimentary introductory call with me using the link in the description. So whether you're 55, 60, 65, the right plan can save you hundreds of thousands over your retirement. You've already done the hard part. You saved, you have this huge nest egg. Now don't let poor timing or missed strategy undo decades of discipline. Retirement should feel like freedom, not fear. And with the right plan, it absolutely can. Thanks so much for watching, and I'll see you in the next video.